As a beginner trader, it's very easy to get lost amongst all of the ICT concepts that are on YouTube, but the truth is you don't need all of them to turn profitable, and there's been 3 main ICT concepts that have turned and kept me profitable for over 2.5 years. In this video, I'm going to be going over all 3 of those. So as you can see here, this may look like a good setup to you if you have watched ICT videos before or have studied the concepts. Right here, we have a 15-minute order block. Price clearly retraces back into this order block. Now, once we retrace back into it, we also see an SMT at the highs. After we see an SMT at the highs, we see a push to the downside. We get a fair value gap retested and a market structure shift. So looks like an A+ setup, right? But obviously, as we can see here, it ends up getting stopped out. That's because none of these 3 concepts have been applied. Now, the first concept I want to talk about is DOL, or your draw on liquidity, okay? This is basically going to tell you which direction price wants to go. And not just direction, not just bias, it tells you the exact point that the market wants to go before seeing a reaction or just continuing higher, okay? Now, there are 2 different types of draw on liquidity. The first one being internal draws, and the second one being external draws. Now, you may have heard of internal to external, otherwise known as ERL to IRL. Now, generally, when we hit an internal draw, we will go and hit an external draw. After an external draw, we will go back to an internal draw. And I'll explain that here visually on the charts in a second. But just so we can understand what an internal draw versus an external draw is, an internal draw is going to be your fair value gaps, okay? Those are going to be your imbalances, your fair value gaps, whatever you want to call them. Your external draws are going to be your highs and your lows, okay, on the external side of things. Now, let's take a look on the charts and see if we can spot some internal and external draws, and can we decide where the market is going next. I'm going to back it up a little bit so I can explain this concept. So, external draws are going to be your swing lows and your swing highs. Obviously, this one is just hit. So, we have hit an external draw on liquidity, and we have now formed internal liquidity, which is a gap. What can we likely think is going to be our next target? This internal liquidity. Now, once we have tapped into this internal liquidity, right, what can we then say is most likely our next target if we are going to remain bearish off of this gap? It's going to be the new external liquidity that we just put in, or the highs and the lows. So if I see price respect and react off of a daily fair value gap or internal liquidity, while the trend is still very bearish, then my next draw on liquidity is going to be this ERL or external low, okay? Now, likewise, we're flipping bias here, right? So we're gonna play this out a little bit. Now, where is our closest external high here? Okay, so we just took out this one, yes, but now we also have an external high right here. We have one right here. So as you can see, after sweeping the first level of external liquidity, we have formed another daily fair value gap. What's our target probably going to be? That gap. Boom. We hit that gap and we react off it. Now where are we headed? We just went from ERL to IRL. Okay. Now we're going back to new ERL or existing ERL. So right here, we're going to want to long on this day to this high. Okay. Boom. Again, we've just hit that external draw and formed a new daily fair value gap. What are we going to do? We're going to be short until this daily gap. Okay. As you can see, once we hit the daily gap right there, boom, we immediately go back to new external and more external. Same thing here. Again, IRL, daily fair value gap, back to ERL. So the concept of drawn liquidity is super important. You want to pay attention to daily gaps, daily swing highs and lows, in previous session highs and lows, previous days highs and lows. All of those levels are going to give you significant draws on liquidity. Likewise, when you're in a trend and you are below the previous day's low and haven't hit it yet, you're probably going to go and target it, right? If you're trending, we're going to wick into the previous day's body, and then our drawn liquidity is going to be previous day's high if we haven't hit it yet, okay? Those are the best ways to find drawn liquidity. With that being said, let's go ahead and jump into the second most important ICT concept. Now, if you guys didn't know, I've taken multiple students from $0 to over 10K a month trading with prop firms using the exact same way that I trade with prop firms and using my exact PO3 strategy. If you are interested in applying, we have about 6 spots left. You can click the first link down below and book your interview call. But with that being said, let's go ahead and jump into the second most important ICT concept. That is going to be your MMXM, otherwise known as market maker models. Now, you may have heard of this, you may have seen some visuals, and it might look a bit confusing or overcomplicated to you. But really, it's a very simple concept in theory. So the concept is you having a sell side curve and a buy side curve, okay? In your sell side curve, we're going to use a path to represent this. You have your climax of price. Once you start to see a push down, the market can't just go straight down and straight up, right? That doesn't happen. The market moves in almost stair-stepping motions. So you have your climax there. You will move sideways, push down, move sideways, push down, move sideways, push down. And this is your smart money reversal here. Okay. This is typically, and this is a little messy, but what market maker models look like. You will have these consolidation or reaccumulation periods of sideways movements, okay? The idea with market maker models is not to be entering when there is consolidation, okay? You want to be participating in these legs of high volume or distribution, okay? Now, not every leg in a market maker model is going to be a power of 3, but as you guys know, I trade PO3. Everything I base my trading on is off of PO3, and these actually play a very big part in the market maker model, okay? Usually, we will get a PO3 to push us lower, okay? We will accumulate, manipulate into the last distribution leg, and push lower. And once we hit a high time frame PD array, we will then have a bullish PO3, which is considered a smart money reversal. So we will accumulate, manipulate into a high time frame PD array, and then distribute. Now, we do often catch a lot of smart money reversals, but the majority of the market maker model in PO3 trades that we actually take are these first or second reaccumulation legs where we accumulate, we manipulate into usually a 15-minute gap with the time frames we're trading on. We manipulate into a 15-minute gap, and then we long, catching the next distribution leg, okay? So this is the basic concept of market maker models. Once you flipped from a sell side curve to a buy side curve, your draws on liquidity are going to be your reaccumulation highs and lows and the climax of the entire curve. Here is a perfect example of a market maker model. So we had a selling climax, and this is ultimately, if we flip into a sell side curve, our final draw on liquidity. But what can we see? We make a push up. Then what do we immediately do? We reaccumulate, we manipulate into a high time frame gap, and then we see a push back to the upside, right? So once we see those pushes back to the upside, that's where we want to long within these market maker models, okay? Now, what do we see again? After this massive distribution leg, what do we do again? We reaccumulate and push back to the upside, okay? Now, this is also, you could have easily spotted this manipulation and longed right about here off a change in state of delivery, but not to overcomplicate it. Basically, the market moves up, sideways, up, okay? And when you get these manipulation legs, that's where you can participate in the best moves literally in the entire market. So right here, we're about to see price flip, okay? We reaccumulated, push up. Now, this is now our climax of the entire curve. We had our buy side curve. It's looking like we're flipping into the sell side curve, but there's really not too much confirmation quite yet for us. Really, all we see is a ton of imbalanced price action get inversed. Okay, now this is starting to look a little more bearish. We've Taking that low, what do? We have a small reaccumulation period. Like I said, not all of them are going to be picture perfect, but we do have a reaccumulation, okay? And then another push to the downside. So to participate, I'm going to be waiting for another one of these reaccumulation legs, right? If you just try and chase it, you're going to get chopped out. So what do we see here? We see price reaccumulate. We see a manipulation into this gap, and then we see a push lower. Now, what's my target going to be for this? If I was shorting this market maker model bearish PO3, I'm probably going to be targeting this low and then the climax low. Now, the third most important concept within ICT trading is what we call price action based order flow. So this is not me opening up Bookmap. I'm not reading the tape. I'm not doing any of that. This has to do based on PD arrays on the higher and the lower time frame. Okay. Now, if you have a lot of good confirmation within a trade setup, let's just say we have an A+ setup, PO3, market maker model, SMT at the highs, then occasionally we can take the very first inversion fair value gap short, okay? But not every trade is going to be picture perfect. And also this applies to the higher time frame too. What we ideally want to do is see one side of the market get disrespected. So bullish gaps get disrespected, and then new bullish or new bearish gaps form. Those get respected, and then once we see a breakout of that, we can short. So I know that may sound a little bit complicated, but basically, if you're bearish, you want to see bullish PD arrays get disrespected and new bearish PD arrays form and get respected. So let's take a look at that on the charts. We can literally see it pretty much anywhere. So this is a perfect example of what I mean. So we have inversed a bullish gap up here and then formed a bearish fair value gap. So we need to see that gap get respected, which it does. It gets respected, and then we see an additional break to the downside. And also with that break to the downside, we disrespect another bullish gap. So as you can see, bullish is getting disrespected, bearish is getting respected, and even if we wanted to wait for, oh, I just want another gap retested, boom, bearish gets respected again. So one side of the market is creating PD arrays that are being respected, and the other side of the market has gaps and PD arrays that are being disrespected. So this right here in my eyes would be an excellent short opportunity to go and catch a solid amount of points here. Now, that being said, I think overall the most important thing is to break your model down as simple and try and get it as mechanical as you possibly can, so that you can go and backtest it very easily. You have a checklist on exactly what you want to enter every single day. You can rank your setups, and it's not based solely on discretionary trading. But if you can make your model really mechanical, like I have with my time-based 10 a.m. PO3 that I trade every single morning, then you can turn profitable a lot easier, because it's going to make you follow your rules a lot easier. When you're not trading a time-based and somewhat mechanical model, you don't know if you're going to follow your rules. It's hard to have a organized trading plan, but with this, literally I just check something off the boxes every single day, and that's how I get my entry. Win or loss, I'm off the charts. Overall, I know I'm going to be profitable at the end of the month, at the end of the year, and I know I'm going to be taking consistent payouts with this model. So why would I trade anything else? Again, with that being said, if you do want to claim a spot in the one-on-one lifetime mentorship, it's going to be the first link down below. Hopefully you got a ton of value out of this video, and now you can focus on the concepts that actually matter.